Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Missie Beach. Hey, Missy.
Hey, Casey.
So today we are going to talk about ways to be growing and passing down generational wealth. And I feel like this is we've touched on all different angles of this topic. I mean, this is episode 175, Missy.
That's a lot.
We've covered just about everything at this point, but we and I'll reference some podcasts here in the past. I'll go to reference one is if you really want to learn about passing on generational wealth and how to do that. We have a great one with James E. Hughes. Brad and I did that interview, episode 117. What is generational wealth and how do you preserve it? And James Hughes has written multiple books on the topic. And so we really focus in on passing down generational wealth and how to do that. We'll touch on some of the highlights of that here. But I feel like a lot of clients today that we're meeting with have really good incomes and they're doing really well. And I think they are thinking about, hey, I want to make sure our kids are taken care of, that they have ability to be educated in almost any school they want to go to, and that maybe we can start a fund for them. Because you think about, I don't know what your first house cost, but my first house was, I think, less than $100,000. And, for the young people joining our firm now to buy a house around here, probably at least $500,000. Oh
yeah.
And you got to be putting down 20%, but even just 10% to come out of school and then have $50,000 that you got to put down on a home.
That's tough.
That's crazy.
Yeah. Times have changed.
California's come here. So, having that head start, and I'm sure there might be some listeners that say, well, I did this on my own. They can do that on their own, but that's not how you build generational opportunity, generational wealth, where something's passed down. So maybe we should start by defining that. How would you define generational wealth, Missy?
Well, obviously, you hear generational wealth, and I think the one name that comes to mind is Rockefeller wealth. And that's the trap that people fall into, thinking like, oh, I don't have generational wealth. I'm not a Rockefeller. But it's not just like the uber wealthy that have generational wealth. I think really the base definition is if you're not going to spend all your money during your lifetime and you're passing some on to the next generation, well, hey, that's generational wealth.
Right.
So any family, any client that has more than they could reasonably spend during his or her lifetime has generational wealth, and I would argue a duty to impart his or her wisdom to the next generation in how that money should be spent or saved or used to better the family, the business, the world, an educational institution, a cause, just whatever it might be.
And accumulating to that point is something that if you say, man, I want to stop kind of like living from generation to generation, then if you're a young person listening to the podcast, you have the ability to do that. And it's called saving early, because you have that ability to compound. Even if it's just a few $1,000s a year that you're putting into this side account for the next generation, you're able to do that. But you have to do that and also teach about financial literacy, money management, right?
Yeah.
I mean, there was a study here that TIAA did. 61% of people in this study could identify like loans, like how to borrow money and pay it back. But beyond that, they didn't do so good, like understanding the risk related to that, understanding a risk reward. They didn't test as well or have as much knowledge about that.
And I think that's sad, because if you go into the way back time machine, you have cavemen, okay? And during the time of cavemen, like, nobody had secret bank accounts. No one was uber wealthy.
Right.
But like from that time period to today, like some men and women figured out how to accumulate wealth and to pass on generational wealth. So there's no reason why someone young and in the accumulation mode can't be the one in their family to begin accumulating generational wealth. So that goes back to what you just said to the young people out there. Like, okay, be that person, be that change agent in your family to begin the accumulation of generational wealth, and you be the impetus, and you get to decide like what it means to you and the people around you in your world.
Yeah, but there's other ways you can well, it's about education, especially when they're young, but then having family meetings and telling a story and communicating about, this is what my wishes are and this is what I would like for you guys to get on board with. And I would think most of the time that family members are willing to do that. But we've had, I can't remember which client it was. I just remember the story. Not that we would say their name anyway, but I remember a new client that came in and said, well, this was from my mom and my dad, and they worked really hard for this. And I just want to make sure I protect it for the next generation. And I noticed they had other siblings. I said, oh, well, do your other siblings have advisors that they're using? And she said, oh, no. One booked private flights for like 5 years everywhere he went, and all the money's gone. I was like, man, how sad is that? And so there are trusts that you can set up to help protect from certain things like that. In James Hughes's book, when he talks about generational wealth, he talks about the ability to create, basically you eliminate the banks. So this is obviously bigger. You sold a business or something happened, and so I have one sister. So maybe she and we paired together and we put money 50-50 into this, some type of a trust account that is then there for one single purpose, and that's loaning money to the family. So you get super low interest mortgages. You get someone who wants to start a business, they come and pitch it to the family, and the family says, okay, I think we can help you, start that. And so, in his book, he also talks about a family back in World War II that the dad sent the kids to different parts of the country before World War II started to create banks, because they were a banking family and they were really good at creating banks. And only one of those banks ended up surviving after World War II because Europe is so decimated that, most of those banks didn't survive. Wow. Obviously everything was in rubbles, right? So in the end, that one branch, I believe it was maybe in Australia, was then able to kind of prop up the rest of the family and continue that generational wealth. So it's thinking bigger than yourself. I think in today's society, that's tends to be a little harder, especially when things are so expensive now. But for, we're not really talking this podcast probably to everyday Americans. We're talking to people who either want to make a change in their family or they already have, they've created businesses that will generate this wealth for future generations.
Yeah. How to expand outside your own footprint and impact others.
So, I think step number one is always understanding that you're always building towards something and setting goals. And so, my kids roll their eyes at me, but I make them, my son's really obviously into golf. We've talked about this in the past, but every year I make him write down what his goals are for this year. My daughter's an equestrian, and I'm like, look, we're not driving to horse shows just to drive to horse shows for the fun of it. we go to horse shows that have a purpose. And so I want you to write down what your goals are, where you want to be on 12/31/23. And then every decision that we make will be based off of, does that help us achieve our goal? And it really cuts down a lot of the Amazon purchases for the barn.
Yeah.
Because she could buy stuff on Amazon. I'll pay for it, but it has to come through approval through me. And then my comment is always, how does this help achieve our goal?
Oh,
right.
I like that.
One of the horses keeps stepping on his own feet. And so he ripped off a shoe yesterday. Now he's like lame for like a week until you can have covers put on like their feet. I don't know the exactly term, but that's a good purchase. I'll pay $17 for the hoof covers because he's done this twice now. And it
second time.
We can't go run a show on a lame horse. So that makes sense, right?
$17 well spent.
It's the same thing when it comes down to setting your own personal goals. Like, what are your career goals this year? What are your family goals this year? What is it you want to accomplish? And does that meet that purpose, right? So in your business, if you're growing a business and you want to liquidate it someday, what is the purpose? That's a great opportunity to create the trust that you need and funnel assets into the next generation when something like that happens. So that there's, financial success is intentional. That's the theme of our podcast. And so this stuff doesn't just happen by accident. You might be born into it, and that seems a little more like, okay, it's the lottery, right?
True.
But if you're the person creating the wealth and you want to change your generational trajectory, then it's a purpose, and you don't have to be a Rockefeller to do it. You don't have to own a business to do it. You can just be a really good saver.
Exactly. While financial success is intentional, I think families need to realize that it's not always a positive outcome. And during these family meetings, talk about your success, but also talk about your failures and what it is that has come out of that. And maybe talk about amongst yourselves, like how you could better address that the next time and what it is that you have learned from that and how you can make yourself better. Because I feel like in a lot of highly successful families, like the failures just kind of get swept under the rug. Like, oh, no one really saw that, did they?
Right.
That didn't happen. But when you're passing down generational wealth, I feel like you have a duty to yourself, to the family, to the money, to do what's right and to address what went wrong and to optimize everything. And don't be afraid or ashamed or upset that something went off the rails, but that's your biggest chance to right a wrong and to figure out, hey, we didn't know everything, but let's figure out how to fix it from here. We're smart people.
Right.
And so that takes away the arrogance out of a lot of it. And that's the biggest stereotype that outsiders will think about generational wealth. Is like, oh, all these people are so arrogant, can't admit that they're wrong about anything. So I think coming at it from a humble perspective and knowing when, maybe we weren't right on that call. So this next time we'll approach it a different way. Yeah.
You also have to create a sense of a strong family unit for that to happen. And what I see a lot of times is the kids are kind of pitted against each other. Maybe it starts off with just time. You want time with mom and dad, and then maybe they're not getting that. But ultimately, it translates into dollars as they get older. They feel like they're owed that for some reason. And it's a sense, you have to create that sense of unity where everyone in the family is working together, and if one's successful, then either they're all successful or they're happy that the other one is being successful, because you're going to do different things. I mean, everyone's going to have different interests. There will be some people in the family that can generate more income than the other, but that's not what it's really about. And once you establish that multi-generational asset, which we should probably talk about what that looks like, then that kind of supports everyone in the group equally. So on that note, I think, it's not just stocks and bonds. I think so many times we listen or read articles that people have written from our industry, and they always assume the money's in their company, right? Yeah. Build multi-generational income with whole life insurance. That's not going to happen. build multi-generational income with my mutual funds or my stock picking or what have you. And we were definitely not self-serving in that manner. But I see it as a multi-prong approach. And if you have a family business, it's building a successful business. So maybe it's hiring a business coach to really help you understand how to run and operate and scale a business. Most people can run a business, but they can't scale it. Mm-hmm. That's a very small percentage. It could be taking the profits from the business. So you take, let's say you have, you have 20, 30, 40% profit margin. Where does that money go? Because you're probably already paying yourself a salary. So the profit margin has to go somewhere. So maybe that's in a vacation property, which maybe that vacation property gets traded out for another one or multiple ones. And so those properties will continue to grow in value. Maybe they generate income because they're out there on the rental market. Yeah. So those are assets that can be passed down and held by the family, correct? Imagine it's harder to do that now, but 30, 40 years ago, you could pick up rental homes for 50 to 80 grand, right? You were the slumlord, yeah. But still, accumulating that. There's a lady involved at Berry College, one of the trustees. I've only met her a handful of times, but I know people who know her well. I think she has over 100 rental properties, like in Floyd County alone. Like, what a great way to pass on generational wealth, because that's all at very low debt, or if any debt. Yeah. So that's all income being passed on to the next generation. And then obviously you still have to have liquid assets. You can't have all your money in your business. You can't have all your money in real estate. You got to have enough in liquid assets to be able to maneuver. So obviously a trust account that's well diversified can generate 3-4% a year very easily today, and that's not even taking into account growth. And so those are assets can be passed down. So it's kind of those three areas I feel like is what you're looking to build to then send to the next generation. And then how you're going to do that is really multiple ways. But number one, and we've said this on many podcasts, is you have to tell your story. You have to create a sense of, my dad started this business and he was never home. He worked all the time, but he created this for our family, and it's a sense of legacy for us. And we're going to maintain the business and maintain these values, or the business was liquidated and now we own these properties and we have this portfolio, and we get an income stream, but the principal is always protected. That's the kind of story that you want to be proud that we're the
legacy.
Yes, correct.
And in fact, I was just talking to clients this morning who had a recent inheritance, and they were worried about doing the right thing and this and that. And I said, it doesn't matter. We are going to put together a plan, and you are using the inheritance from your dad to carry on your best life. And your dad, I'm sure, will be happy with whatever it is that you decide to do that's going to make your plan work out the best for the rest of your lifetime. Right. It's, this special gift that he's provided you with that's going to give you relief from your normal life in this rat race. And this legacy that he's bestowed upon your family now gives you the financial freedom to have choices. Before it might have been this, more prescribed route towards a traditional retirement. But now, you've got more years on your side, more spending on your side. And it's truly a gift. And there's not going to be wrong answers. It's just going to be how you go about finding your path.
Right. Exactly. A lot of times with inheritance, I try to figure out ways to get like real estate paid off. Yeah. Because I feel like that they can actually see it.
Yeah. Like, that's
that this house is paid off, and it's still appreciating in value. It's not like you spent it.
Exactly.
What I hate doing with it is having to eliminate debt.
Oh, the credit card debt.
Yeah, right. Because you're never gonna really get that back.
And it might come back.
It might come back. Yeah, exactly. Obviously, that's not what our target audience is doing, but But yeah, that's always sad. I feel like to have to do it, but you have to at least give it a shot. And I give them a good lecture.
That's all you can do.
That's all you can do. All right. So, there's other ways to preserve this, and this is where it gets more into estate planning. But it all starts with the story and your legacy, and it's being passed down from generation to generation. The second part is setting up the structure, right? So
yes.
You can just divide by 3. Or if you have 3 kids, you divide by 3. It goes to the 3 kids, and you told your story, and that's important. But if you have significant wealth, you really need to go a step beyond that. And that's to creating the right kind of trust. And there's multiple trusts that you can try to navigate through. And we could do 5 podcasts just on the various trusts and how to set those up.
Yeah, I'm even of the opinion now, I just worry about these kids inheriting substantial sums of money really at any age, even adult kids, with all of marriages gone wrong these days and lawsuits and everything, that I'm kind of recommending clients leave money to adult kids in trusts, maybe even for perpetuity, and letting them name a friendly trustee at an earlier age. And that just keeps the family money in a trust and protected from creditors, bad spouses. And
Right.
It just has that extra layer of protection where they can get it out if they really want to, because they have got a friendly trustee that'll say, sure, buy your Ferrari, that's fine.
Right.
But if your wife wants to open like that nail salon, you can say, I'm sorry, my trustee won't let me do that.
Right. Exactly.
So I feel like, you have to think about that structure, even though your kids are perfect and great. The people around them might not always be perfect and great as they go through the decades.
Or they might trust people that aren't trustworthy.
Yeah.
Trying to take your inheritance and put it, majority of it, in annuities and whole life insurance.
Ugh.
Right? They're protecting it.
Casey, that's sad.
It happens, unfortunately.
Yeah.
No, I agree with that. I don't think we see that here as much. I think a couple of cases we're working on now is like a family limited partnership because the business is over the exclusion
And
gifting. And so basically they're passing down shares to the next family. So certain kids will be operating or directors at the company and some will just be shareholders.
Okay.
So it's getting really creative in setting that up, which is really kind of another point that we had for our podcast is assembling a team. You need a good financial planner that is able to direct traffic and say, okay, this is what the goal and mission is. Now I'm going to bring in this estate business specialist, and then I'm going to bring in the appropriate CPA, which could be multiple, really. If you have a personal CPA versus business CPA, those are 2 different expertise. Generally, our CPAs here we work with are more geared toward the complicated. So we don't have to do that as much. But some people do have different CPAs, one for the business, one for personal.
Yeah.
And then, obviously, even like an insurance agent, really, and you have to keep them in their lane.
No.
but just making sure that you've protected your assets. I think the most common recommendation we're making in our financial planning right now is people don't have umbrella policies.
No.
So they have a net worth of $5 to $10 million, but they don't even own protection past $500,000, and they have very little debt. So that means that all their assets are up for grab if there were a terrible accident that they were responsible for.
Yes.
So you want to be carrying typically your household insurance. The State Farm, as all states, they'll stop around $5 million for an umbrella. Some stop at $3 million. But
it's hard to get 5.
Yes. So I tell them is that and I say this very jokingly, is like, you worked really hard. You still have common people insurance. Yeah. You need rich people insurance. And I hate that word rich, but I use that in that context, just to provide some humor to the situation. But Yeah, there's Chubb, Vault, Pure. Those are all insurance companies that if you have a home worth over $1 million, you should not be using.
Get away
State
from
Farm.
the mass market.
Correct. The rest of us who have homes less than $1 million is different. But after you pass that $1 million threshold, or if you have really nice cars, you should not be using your standard insurance. So anyway, we have a process for that too. We use Kimberly over at the Dickerson Agency to help us shop for that, and she can do the high end as well. And then we also have an agent that we'll use occasionally for the ultra high net worth when it comes down to making sure that they're properly insured. And it's not you're not looking for cheap insurance at that point. You're just looking for quality of insurance.
Oh yeah.
When your net worth is over those $3-5 million ranges. So anyway, the point of all that is assembling your team. So who's on your team? Is your team working in your best interest? Does your team understand what your goals and objectives are? That's the important part. And that's what our roles as financial planners are, is to direct traffic and making sure that everyone's moving in the right direction.
Absolutely. One technique that I see less of these days is just randomly writing annual gift checks.
That has kind of dropped off. I've noticed that too.
And I don't know if that's because people want more control, or they don't feel like they've got the excess that they just want to freely give away right now. They're holding it tighter to the vest.
I think it's a COVID result.
Maybe that is
where
it.
We had that big drop in the market. Everyone's worried about their health.
You're right. That's when it dwindled off.
Yeah, I think it's a COVID thing now that people aren't writing because you can do $17,000 a piece.
Yeah.
So if you have 2 children, mom can write a check to each child for $17,000. Dad can write a check for $17,000 for each child and pass it to the next generation. Now it's a drop in the bucket for most families, but it does
high net worth.
It does help move money out of one estate to the other, but I think that's because people are still kind of in protection mode, because 21 was kind of an adjustment year, and then we had the big losses in 2022.
So no one was thinking.
So no one feels like they can do gifting now.
No, they're trying to earn it back.
Exactly. Well, that's where planners are able to make suggestions.
Yes.
And it's always hard for me to suggest that when they're younger.
I know. When they're in their 50s and they've got these big estates.
Because you just don't know. You just don't know what's around the corner sometimes, or what the client's going to want to do. But yeah, certainly in 70s and 80s, gifting sort of definitely makes sense. So I guess other ways to protect it. So let's just be blunt about this. I mean, if you have significant assets, you're moving to the next generation, have your kids get prenups.
Oh gosh, yes. Mm-hmm.
I think that's one way. Mm-hmm. And you can make yourself the bad guy. You look at the future spouse and say, "We love you very much. We're so excited to have you here," but we're also got to protect our interest.
A business transaction.
Correct. Mm-hmm. So having children sign prenups would be one. Obviously, you can control some of that through a trust. If it's an irrevocable trust, you can name who those beneficiaries are and what the criteria is for withdrawing.
Yes.
And if you don't have a close family friend or a successor to that friend, even Cumberland Trust, based out of Tennessee and Georgia here, are great companies to have as trustees.
Yes, independent corporate trustees.
Correct. They don't manage assets, not a bank. They don't manage assets. They simply just are the administrators. And typically you want to make sure you have at least $2 million that would be under their purview to make that worth it.
But trustees like that know you as a client,
yes,
as the beneficiary of the trust, and will make good on everything. I mean, it's amazing what some of those trustees will do.
Yep. And then obviously looking at tax planning for the next generation. So right now, if you leave a large IRA to the next generation, it has to be withdrawn over a 10-year period. So if you look down at your kids and you see that your kids are in a very high tax bracket, perhaps it's better for you to do a conversion into a Roth now in a lower tax bracket before it's transferred to them. That protects the dollar. If they're in lower tax brackets, then the opposite's true. You want to keep it on your side as long as possible. And then once they withdraw, there'll be a tax strategy for them. But having multiple generations at a firm also helps. We have several multi-generational families here. And so when I'm working with dad and I can see the transition, he's ready to transition out of the business, I can immediately see the what's happening at the kids' accounts and their tax returns. And so you're very able to kind of direct where assets should go versus the family being scattered with multiple advisors.
Yeah, you're not guessing about tax rates and generations.
Correct.
It's so helpful.
And independent advisors, I think for the most part, we play pretty well together.
Oh, yeah.
But if you're asking me to go to like a Merrill or an Ever Jones guy, they are going to be super defensive.
Yeah.
Super defensive.
And they're not going to
play
well
yeah,
or work well.
They're not going to work well with independent advisors. We're evidently a big threat to them. That's because we do real financial planning.
I was going to say because we're doing real work.
Yeah, we're doing real work.
We're not going to walk in on our project.
Not just collecting an assets under management fee.
No.
But yeah, I had to work with a Northwest Mutual recently, or I tried to, and like the guy wouldn't even take my phone call. So it's just really strange how that works. Where if I called another independent RA, it'd be like all buddies immediately. Yeah. For the most part.
Another NAPFA advisor.
Another NAPFA advisor, exactly. Like, working jointly with a family together. That usually goes pretty well. But so having your team, understanding a tax strategy. Team also, obviously, I think I didn't mention attorneys, but attorneys almost show up in every case. But you want to have an attorney as part of your group that understands what's happening, and maybe different multiple attorneys, because that same attorney, your corporate attorney, is not the same as your estate planning attorney.
No, because it might be a life insurance trust for a second to die policy to cover some estate taxes if that's an issue. Correct.
And then I think lastly, I'll add succession planning for your business.
Oh,
so
you'd know a little about that.
I know a lot about that, and I'll say it is one of the hardest things. We have a rough draft, I guess, but it's really difficult, especially if it's a business like ours at Wiser that's growing, and so we're adding great people like you, Missy, but we don't have that 5-year track history, and you're still learning a lot of things we do here. Not the planning side, you got that down, but just like the operationally and procedures and stuff, corporate wise. And so it's very tough, and especially for me, because this is my baby. This is the product. This is a reflection of me, right? This company. And so for any other business owner, it's the same for them. It's not any different. And so that's where it goes back into your counsel for business, and how you transition that is very different than what I would do if I was an employee here. Yeah. So but you have to have it in place. Are the employees going to buy the business? Are you going to transition the business to a competitor? Is there an arrangement? Do you have a business broker even picked out? Say, hey, if something happens to me, I want you to broker this business. I would say you have to make the business as little as about you as possible, which is a whole nother business coaching thing, right? Yeah. So it's. I think our next episode is with Marty Paradise Consulting down in Charleston, South Carolina. But that whole episode is going to be about how to grow and scale a business, because that's what business owners need. They need to understand that it can't be just about them. No, there's got to be an end game. So in the end, multi-generational wealth can be passed on successfully from generation to generation, but you have to tell your story. You have to have plans in place and be intentional about it, right? If you're not there, if you don't have multi-generational wealth in your family, there are ways to do it. And it starts with living below your means, staying away from debt, right? And building an asset and teaching the next generation about money. And so maybe they can pick up and go from there. Yes. Avoid lifestyle creep and stay educated. Yeah. Absolutely. Cool. Easy enough. Let's do it. Before we wrap up this episode, Missy, I just want to commend you on a job well done. We had a person come in recently who was being kicked out of their wealth management firm. And this is where I get so frustrated with my own industry. But basically, it's a very nice lady who had a good amount of money in her brokerage account. Then the advisor took the money out of the brokerage account to buy an annuity for her and a whole life policy. But then the brokerage account depleted down quite a bit because of those two large purchases. And then now he's kicked her off the platform because he doesn't have enough assets under management to be on the platform anymore. But he is keeping the trailing commissions from the two products that he also sold. And this is a local independent financial planning firm is what they have on their website.
Very local.
I don't think there's any planning done other than his own income planning. But
personal.
Missy has taken the case on, and she's done a great job of contacting the annuity company and trying to figure out what all the options are, which I think we've laid out some options for her. But ultimately, this was all done. This was where it hurts. This was all done by a certified financial planner. Mm-hmm. This is a CFP, certified financial planner. These are the people that are supposed to sign the oath that they're going to do work in the best interest of the client. And that's not what happened. And unfortunately, because they're in this broker dealer realm, you'd have to file a complaint through FINRA, and the chances of winning are almost zero because probably somewhere along the way she signed some 5,000 worded small print document that cleared them to do all this.
Even though it's totally unsuitable.
Correct.
And puts her in an awful position now. And
so that just, to me, reminds me that fee only is the way to go. This is a fee-based company, meaning that they're supposed to be fiduciaries on one side, but then when they sell those products, they don't have to be fiduciaries. And who told her when he was not going to be a fiduciary and when the salesperson was going to be? No one does that.
You can't toe the line. You
Right.
either are or you're not.
Exactly. But that's an error in our structure in the United States anyway, and how people can set up their companies. But I was going to say thank you for extending the heart of Wiser in taking care of her.
Sure. We're not out of the weeds yet, but we will get her there. That's for sure. We're not going to leave her hanging.
Episodes you might want to listen to: episode 152, 10 tax planning strategies for high net worth individuals. That one may have been with Jordan. I think that's a good one too. Episode 128, transferring wealth from generation to generation. I already mentioned episode 117, generational wealth and how to preserve it, with James E. Hughes. That was a great fast-paced podcast we did a while back. Don't forget, we also have a YouTube channel, A Wiser Retirement, available on YouTube. We have a couple of videos we linked here: asset protection for high net worth individuals and building a legacy beyond financial wealth. Thanks for listening to today's podcast episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, like Missy, you can do so by going to wiserinvestor.com, or you can click on the link on the episode notes. Thanks so much, guys, for listening. We'll see you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.